It was my first day on the job. I was walking to lunch with my new boss, Sheldon Turk, who happened to be one of my industry heroes. And he asked me one question. Do you sell life insurance for death benefit or cash value? I said, death benefit. He said, good. Cash in the estate through the death benefit is sacrosanct. Here's what changed since that conversation. Today's participating whole life products are made for bank financing. The 2017 redesign eliminated lapse-supported pricing and created high early cash values. Banks now lend 90% to 100% against guaranteed increasing collateral. Tax law allows interest deductibility if structured correctly. You don't need life insurance. You want to put your affairs in order. You desire peace of mind for your family. The first principle of finance is leverage. Use your idle equity skillfully. Take calculated risk by investing while controlling a strong financial foundation. For many families, this should seem logical, but only if you trust the delivery team and understand the math. Here's the math. Let's talk. Let's start with what changed in 2017. Before that, participating whole life insurance operated on a version of something they called lapse-supported pricing. Look at these numbers from a pre-2017 product illustration. If you choose the traditional protector option, your year one cash value is 55.5% of deposits. Year 5, 63.2. Year 10, 86.5%. If you surrendered early, you lost a significant portion of the money you had invested in this product. If you wanted a higher early cash value, you could choose the accumulator option, and then you'd see at year 1, 83.1%. At year 5, 94.1%. At year 10, 102% of your money was available. But that came at a cost to long-term death benefit performances compared to the other options. You had to choose early cash values or long-term death benefit. You couldn't have both. And here's what made it worse. Lapse-supported pricing meant the product was designed assuming a certain percentage of policies would fail. Those who left subsidized those who stayed. Someone had to lose for the math to work. But that was all about to change. In 2017, the life insurance industry, working with Finance Canada, completely redesigned participating whole life. 3 fundamental changes. First, lapse-supported pricing was eliminated. No more designing products assuming a certain percentage would fail. Every policy had to stand on its own economics. And second, high early cash values became standard, not a choice you had to make that sacrificed something else. You got both early cash values and long-term death benefit performance. And third, the product became a legitimate long-term fixed income allocation. Current dividend scale interest rates range from 5.5 to 6.4% today, depending on carrier. This redesign created an opportunity. Banks will now lend that 100% against these guaranteed increasing cash value. And here's where the math gets interesting. Say the bank charges you 6% interest on the loan, and the participating whole life policy is crediting 6% dividend scale interest rates. Same rate, no spread. But if the loan interest is deductible, the net after-tax cost is lower than 6%. At a 30% marginal tax rate, your 6% loan costs you 4.2 after tax. You're earning 6% in the policy, paying 4.2% net on the loan. That's a 1.8% lift. And at the top Ontario marginal tax rate of 53.53%, you're paying 2.79% net while earning 6% on the policy. That's a 3.21% lift. This is tax arbitrage. And we're in an ever-increasing tax environment. Every time marginal rates go up, the value of your deduction increases. But the interest is only deductible if you structure it correctly. And that's what we need to talk about next. Here's what nobody's connecting. This is how it gets taught to advisors versus what consumers need to know. This is the end of a 75-page presentation from a 2025 STEP Atlantic Branch Conference. Client chose $10 million coverage, $800,000 annual premium. Borrowing facility established. Client has paid for 3 years. Advisors see this and they get excited about commission. That's the focus. They make it look simple. They call it free life insurance. Here's what consumers should hear instead. You want life insurance, but you don't want to pay for it? Well, because the policy is leverageable and interest can be tax deductible if structured correctly. You can finance insurance while maintaining equity allocation. That makes permanent life insurance accessible for families on a much more reasonable price, not just the ultra wealthy. That's not how it's taught. It's taught as a big case with a big premium. And here's what makes it worse. You've probably heard of infinite banking, IBC, be your own banker. With IBC, you will borrow from your own policy using policy loans to purchase personal use disposable assets. That interest is not tax deductible, ever. So if someone sells you IBC without explaining that proper bank finance makes interest deductible, and without showing you both scenarios side by side, they're not giving you complete information. IBC success rate is very low when interest compounds non-deductibly for 30 or 40 years. With proper bank financing and deductible interest, a 6% loan costs 2.79% net at top marginal rate. That's a 3.21% difference that compounds in your favor for decades. Now, let me show you the most important things you need to know if you're considering this strategy. If you're considering bank financing of life insurance, here are the three most important things you need to know to manage the risk. First, the deductibility test. You cannot borrow money to buy insurance and deduct the interest. That's prohibited. But if you have capital you're planning to invest anyway, if you have income that you're putting into your business, into markets, into income-producing assets, you can use those funds to pay the premium, then borrow it back from the bank using policy as collateral, and invest the borrowed funds where you plan to invest anyway. The CRA test is simple. Are borrowed funds being redeployed actively into income-producing use? If yes, interest is deductible. Second, the documentation requirement. Your accountant documents that link every year. It's called fund tracing. The borrowed funds must actually go to income producing use, not just on paper, but in reality. Your accountant must be able to prove if CRA asks. Without proper fund tracing, the interest isn't deductible. Without deductibility, you're just doing an infinite banking, be your own banking approach. And third, the team you need. This requires an accountant managing annual tax compliance and fund tracing, an insurance specialist who understands the leverage mechanics, a banker committed long-term, and someone coordinating annual reviews, monitoring the spread, loan-to-value ratio, tax deductions, cash flow, etc. Now, here's what I don't know. Is long-term coordination even possible with today's compensation and regulatory structure? Advisors get paid up front, virtually nothing in years 2 to 40. Now, I'm 72. Who provides the paying attention when I'm 82, when I'm gone? I suspect AI will help. I hope team-based approaches emerge, but I can't promise that exists reliably today. But what I can promise, if you want to explore this further, let me introduce you to the best specialist I know. Graham Bergsma, founder of G3 Wealth Strategies. Graham builds smarter, more sustainable insurance strategies. He integrates tax, legal, wealth, and estate planning into one cohesive process. Graham works with top insurance carriers and independent distributors across Canada. He assembles the professional team, coordinates fund tracing with your account, establishes bank relationships, and manages annual reviews over the long term. Is Graham the complete answer to the paying attention problem? I don't know, but he's the best specialist I know in the bank financing bucket. He'll put it in writing, not if, but how, and he'll assist with managing the risks in his area of responsibility. Our job is to educate. Yours is to choose. This is Jeff Kate.